Hello, everybody. Welcome to the Trading with Ashley show. Well, the week of partying is over, both for Thanksgiving week, if you celebrate Thanksgiving, and then also in the market. We had some fun this week within the community, trading quite a bit. Hey, we did some buy rights today. The annual return on investment was incredible, and those trades are closing out 100% in profit today. So if you're in the community, I enjoyed it with you this week. We had a lot of fun. If you're not in the community, you want to take advantage of the Black Friday special that I'm running right now. There is a 10% off any of my programs if you click the link below, but you have to hurry because this offer, it closes down at midnight on Monday, midnight EST. I would love for you to be in a community so I can help you real time. And today I have a treat for all of you because I am going to teach you how to build a proper call debit spread. Some call it the bull call spread, but basically you think a stock or an ETF is going to go up when you put this on. You want limited risk, and it will also come with limited reward, but it is a great trade, especially if you're working with a defined amount of money and you want to stay within that budget for the trade. Now, let me explain first what this instrument is and how to build it, and then we're actually going to go into the computer and I'm going to show you the keystrokes that you might want to use. Now, the reason I am talking about this to you today is this debit spread that I'm going to do. It's a bullish trade on the market. I think the market is going to go up. It is actually best done on a red day for the stock market. Well, if we have any kind of pullback next week, that's actually very healthy for the market. It'll help us to continue up. But that first pullback, I plan to actually execute this debit spread. That first red day next week, my plans are to put it on for additional bullish trades for the following couple of months. First, we're going to take a look at the indexes so I can share with you the best time to possibly enter a debit spread. We have a lot of information going on. Let me show you what's happening. You see right here, we have this 608 line. This is the 50-day moving average. Now, my thesis is that when the institutions come back next week, if there's any selling pressure, that we will potentially come down and touch this 50-day moving average. If we hit the 50-day moving average and regain it, that's very bullish, and we might be off to the races for our Christmas rally. So I will be watching this closely, and if I see that we don't go too far below it and that we will more than likely regain it, I will deploy this trade. It is best done on a red day so that you can get the best possible price on the purchased call. So I'll be watching this next week, and if you want to follow along, you can watch it as well. So keeping that in mind, let's go to the option chain, and I'm going to show you how to properly build this. One of the first orders of business when you get to the option chain, this is the NASDAQ, you need to choose an expiration date. So I am going to look right here at 1/30/2026. You want to go anywhere from about 30 to 60 days out. That helps the option move in your favor after you put it on. And if I want to take advantage of the Christmas rally, this gives time for that to play out. So let's go ahead and click this, and then we will build the spread. For my opening trade, I like to go slightly below the money. So as you can see, the Qs are trading right here. So on a pullback, if this same scenario existed on my pullback, what I might do is go ahead and start my trade by purchasing this call right here, the 618. It's currently at about a 0.55 delta. And it would cost me $2,226 to put this on. But I am going to then go and look for an option to sell, a call option to sell that will pay me, and that will limit my upside, but it also limits my risk. So for starters, you want to consider where the Qs might be trading when you're ready to exit this trade. If I think we're going to get back to all-time highs in this period of time, I might want to ensure that I capture that. So I'm looking right here at 640. Now, if I sell this option, it will give me $11 in premium. And remember, I'm buying this one for $22. So it's cutting the expense to put on this bullish trade in half. Now I'm going to go build this trade in Robinhood so that I can show you a feature that they offer where you can see your risk to reward dynamic. Here's the exact trade built in Robinhood. You can see here I would be purchasing the 618 call and I would be selling the 640 call. So let's look at it down here. They have this great little feature that shows you your risk to reward, your max loss. My max loss in this trade would be $1,133. That's a combination of two factors. That is the premium that I had to pay when I purchased the call, but it also includes the premium I received when I sold the 640 call. If you look at here, the max loss is that 1,133. Now, what's my max profit? Well, it's a little bit under 1,000. So it's very close to that 1-to-1 ratio. This is a trade that I might be comfortable putting on. You can play with the numbers to increase the opportunity, but if you look right here at this is going to show you how this trade moves as the Qs are moving up. So if the Qs actually get to 640 before my expiration date, then I get to enjoy 100% of the max profit, that $1,067. Now, a lot of traders will decide to exit when it gets to about half of that, like at about 50%. You might want to put a couple of these on and leave one running that expires later, and then maybe take profit on the one that expires in the next 45 to 60 days. A couple of different ways that you can consider doing this. Now, if the Qs continue to slide, well, you can see I can't lose any more than what I actually paid for this debit spread. So that's the good news. There is a defined risk. It's what you paid, and then your loss is capped, but it can go all the way up to the strike price that you selected. So for instance, if the Qs keep going past 640, I can't make any more money in this particular trade. So you do want to consider what you are looking at for the sold call, because that is going to be what caps you. If you send this to a ticket, it looks like this. This shows the cost of the trade. So this is how it would work. You'd probably make it good for a day, and then you'd go from there. Again, you more than likely want to wait for a red day, because this amount that you're paying will be less, and it has more upward opportunity if you're getting it at a strong level of support. So let's do a quick recap of how to get into a debit spread. For one, it's a bullish trade. So if you put the trade on, you are expecting the stock or the ETF to go up. If you're going to do this, if you have the patience to wait for a red day and a good level of support like I showed you, that's going to give you your best opportunity for a win in this trade. You always want to look for a risk reward that's similar 1-to-1. So whatever you're paying for the instrument, you want to be able to at least make something close to that and the max profit. This particular trade, if I was to deploy it on a red day, I think that it would probably be skewed in my favor. The reward would be higher than the amount that I would be paying for the trade. As far as your expiration date, you want to consider doing something at least 45 to 60 days out for starters. If you're going to put on multiple trades at the particular level of support that pulls back, then you can stagger your trades so that you have some that expire in that 45 to 60 day mark, maybe some extend out to 3 months, and so on. Now, when it comes time to exit, check your technicals. If the RSI is over 50 but not yet at 70 when you're looking at a 1-month or a 3-month chart, then consider allowing the trade to mature until you get a little bit closer to your sold call strike price. If it appears that we are at 70 on the RSI or higher, then you may just want to lock in your gains and exit the trade. If we pull back farther, just know you can't lose more than you already paid for the trade. But if you decide that the narrative has changed and you want to get back some of that money that you paid, you can exit prior to expiration, and then you can save what's left in the trade. Is your head hurting from all that new knowledge that you have? Now, if you didn't grasp this on the very first go around, that's okay. Sometimes these concepts take a little while to mature, and you have to think through it and watch the video over and over again. If you want real-time support, please join my community so I can help you live. I would love to be a part of your learning journey. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Remember, if you want to take advantage of the Black Friday special, go ahead and click the link below so that you can get a spot on the calendar and you can interview for the position. I would love to have you.